Are U.S. stock valuations high? Some say no. Given the rate of interest right now, this gentleman here, Stephen Auth, says we can expect forward PE ratios on equities to move to the low to mid 20s. Could be. That's usually the sign of the top. 20, you're going to see us peel a lot off between here and 20 on the PE.
Where are they now?
Now they're 15 and 16. Long-term average is 16-ish. This is S&P. We're not looking at the global S&P. Okay. Some say yes. So did anyone know who this guy is? Henry Blodgett?
Yeah.
He spent some time in jail after 2000. He was one of the ringleaders for the selling and pumping of IPO stocks through Morgan Stanley. But he started Business Insider because they said, you're no longer allowed to act in markets. So he said, okay, I'll comment on markets. Anyway, so he thinks things are overvalued. And he's been saying this, had this same phrase over and over and over for 6 years. And this is what he says to look at. He says, look at the Shiller Cape PE 10. Right? This is an average PE ratio over 10 years of earnings. So current price, 10 years of average earnings. And you can see it's high. But look at this. The highest point of the fixed income, of the interest rates, long-term rates, correlates with the lowest point, or one of the lowest points, of PE ratios. The Cape PE ratio. So this gentleman here, Henry Blodgett, is trying to focus us on one item without looking at its other pieces in the market. He's saying prices are too high. And yes, they're very high, but rates are way, 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 way down here. So what is that? So why does that matter? Well, when you're here and you can get a CD for 14%, you're going to do that. Why would I risk my capital for an 8%, 9% average return when I get 14% guaranteed by the FDIC? Why? That makes no sense. Here, I get nothing. I get 0 point nothing for 3 years. I think you get a 1.5% CD for a 2-year lockup. It's probably one higher than that. Someone's going to fact check it and talk to me about it. He's on his phone. He didn't. You heard me. Okay, good. She couldn't. The two. Yeah. She couldn't get 1.5. I know there's a 2 out there.
Yeah.
I know I've seen a 2. Still, if rates are going up and you lock it up for 4 years, you're going to lose by locking it up for that period of time. Okay. So some say it doesn't matter. Some say all this conversation about high PE in the short term is meaningless. And I kind of agree with that. What we're looking at is the long-term return potential from a high PE ratio versus a low PE ratio today. So if we think that the US is a higher price and emerging markets are a lower price, can we buy some emerging markets and sit on it and keep buying it till 7 or 8 years until that comes to fruition? Absolutely we can. Because if we buy the S&P at a 20, if you buy the US at a high cost per unit of earnings, we have to wait to get the benefit out of that. Maybe it has to go down a lot before it comes back up. Maybe there's no increase in earnings for 8 years. It will return to its average 15. So if you're going to buy at 20, you're either going to see a decline in price or a slow increase of earnings to make it worth it. If you're going to buy at 10, you're either going to see a slow increase in earnings, that's what you're going to see, right? And so the price goes up. So there's this long-term history, and we overcorrect on the upside and we overcorrect on the downside along a 6 or 7% kind of a growth bit.